Ladies and gentlemen, good day and welcome to the Music Broadcast Limited Q4 FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashit Kukian, Chief Executive Officer. Thank you, and over to you, sir.
Good afternoon, everyone, and thank you for joining the Q4 FY23 earnings call for Music Broadcast Limited. Joining me on the call is Mr. Rajiv Shah from our IR team and our investor relations partner, Strategic Growth Advisors. Beginning with industry highlights, as per the recent FICCI report, the Indian M&E industry kept up its impressive growth trajectory. The sector expanded by 19.9% to rupees 2.1 trillion in CY 2022. The radio industry registered growth of 29% to reach 21 billion. During the same time period, the industry's ad volumes increased by 25% over the previous year. In quarter 4 of FY23, there was a 12% increase in industry ad volumes compared to the same time last year. Now, talking of our business highlights. During the year, we continued a strong recovery curve with quarter-on-quarter growth in revenue. We also maintained a leading market share across all operating main frequencies with a consistent volume growth. Our volume-based market share has risen to 20% from 19% in the previous quarter and 18% at the beginning of the year, according to the ad check market. We are able to maximize the value we bring to the customers by tapping into the power of our extensive network by leveraging our omni-channel presence and marketing. About 38% of our radio advertisers are served by our company. Additionally, in the quarter 4 of FY23, Radio City secured 33% of the new clients who advertise on the radio for the first time. Our volume-based market share, in terms of sectoral ad spending, the core of real estate experienced 35% year-on-year growth. Financing and the financial pharmaceutical sector spend both increased by 19 and 32% respectively. While the auto sector increased nominally by 3% over the previous year, the food and soft drink industry decreased. Year-on-year, the government sector grew by 11%. In light of the impending elections, we anticipate an increase in the share of government business in the coming quarters. The proportion of digital sales, which we have guided before, will grow in the years to come, and I'm pleased to report that we are headed in the right direction. As of FY23, digital contribution stood at 8% from 5.8% in FY22. In FY23 annual, our non-FCT and digital contribution stood at 32% against 31% in the year before. We believe that the combination of radio and digital will drive the next phase of development in the industry, as it represents a seamless transition to harness the power of technology and expand reach. By leveraging our in-house knowledge and expertise, we have laid down the paperwork in order to develop high-quality content and increased audience engagement. This is in line with our digitalization strategy, which places an emphasis on radio-central digital linkages. As a part of our digital initiatives, we are able to generate 32% of our revenue from newly created businesses, such as properties, proactive pictures, digital sponsorship, and special days. And we have the second highest client count share in the industry, with 38% in Q4 of FY23. I'm happy to share that with regards to the bonus issue of NCRPS, the company received trading approval from NSE and BSE, and the preference shares have been credited to the accounts of the shareholders, and the same is open for trading with effect from April 20th, 2023. Now, coming to the financial performance highlights for the quarter 4 of FY23, revenue grew by 12% year-on-year to 51.4 crores. EBITDA grew by 73% year-on-year to 10.6 crores, while EBITDA margin expanded by 730 basis points to 20.6%. I would like to highlight over here that our operating profit growth have outnumbered the revenue growth. This was mainly on the back of conscious effort over the past few years to reduce costs, which has paid off, allowing us to take advantage of better operating leverage, which has led to faster rise in profitability. Adjusted profit after tax, which is adjusted for interest on NCRPF to the tune of 1.89 crores, stood at 1.2 crores. For FY23, the revenue grew by 18% year-on-year to 198.9 crores. EBITDA grew by 54% year-on-year to 42.8 crores, while EBITDA margin expanded by 500 bps to 21.5%. Adjusted profit after tax, which is adjusted for the interest on NCRPF to the tune of 1.93 crores, stood at rupees 5.4 crores. Our cash reserve stood at rupees 295 crores versus rupees 264 crores in the March of 2022. Our liquidity position continues to remain strong, and as guided earlier, this liquidity offers us the leeway to take advantage of current and potential future opportunities. To conclude, I would like to say that the outlook for the radio industry appears more than just bright, as radio continues to be one of the most relevant mediums to engage the masses. Industry growth coupled with our digitalization strategy and strong control over operating costs will drive the revenue and profitability in the times to come. With this, I would request the moderator to open the floor for Q&A. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from Aditi Sawant with ADM Advisors. Please go ahead.
Thank you so much for the opportunity. I have two questions. First is that, it is very impressive that we have been able to increase the operating margins on the back of conscious cost control measures, which, we must have taken during the last few quarters. So just wanted to understand how much of this will sustain and in what range we can expect the margins to be stabilized at?
So I think costs, right now we are operating at the levels that is, the most efficient way of operating an organization in terms of cost versus revenue results that we talk about. In terms of margin, I think we are already at a 21% margin, EBITDA margin that we are working. And we believe that in the years to come, and especially if we're talking about the next year, that percent should be substantially improved as we go forward from here.
Okay. And is there any further scope of improving our cost structure further?
Though I think whatever cost measures that we had to take pre-COVID and post-COVID in terms of efficiency has already been taken care of. And I think if you look at our overall cost to revenue ratio, I think that is much in line with the operations that we are doing. On the contrary, there can be a marginal increase in cost that we can do on the investments that we'll do on the digital front. But when I say that, I keep clearly a communication that our margins will definitely be at least what it is now or improve. Any increased cost will not mean decreasing margins for us.
Okay, understood. Thank you so much and all the best for upcoming quarters.
Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star, then 1. Our next question comes from the line of Yash Dev with Unique Securities. Please go ahead.
Hello, am I audible?
You are very faint. If you can just be a little louder, or you can increase the volume because it's very faint, Yash.
Hello, is it audible now?
That's audible, yeah.
Yes. So I had one question. The digital business has recorded phenomenal growth and now contributes 8% share of total revenues. We have previously mentioned that over next 4-5 years, digital will be 50%. So what additional initiatives we are talking to reach the desired level?
So 2-3 things. I mean, I've always maintained that there will be a point in time in the next 5 to 6 years that we believe our endeavor, and we believe there is a potential for digital to go as high as 50% of the overall revenues. So the things that we are currently doing which will help us enable reach that is one, through our whole digitalized strategy, what we are doing is currently we are playing a lot on the social media influencer marketing requirements that brands have in terms of using our RJs to kind of enable brands to engage with the followers or the reach of the RJ. That's the first point that we are doing. Secondly, in the content space, we are using a lot of our internal resources to kind of create content on the digital space, which brands would like to engage, across the various platforms that is there. So we are using the talent, resident talent in the form of RJs, content creators within the system to create products and put it on social media platform, which in today's world a lot of brands wants to engage because that gives them the stickiness with the audience and the communication which is far more engaging.
Okay, thank you. I'll get in the queue.
Yeah, thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star, then 1. Our next question comes from Ansh Manik with Quirius Securities Private Limited. Please go ahead.
Hello, sir. Thanks for the opportunity. Sir, just one question. If I want to compare the advertising rates compared to the pre-pandemic level, what would be the discount rate or lower rate by?
See, today, if you really look at the average rate for the industry, it is still at a 75% of the pre-pandemic rates, which is where we believe that as the market gets saturated in terms of volume utilization, that will be the first port of call for all radio players. So till the time there was available inventory in the market, which unfortunately was the case in the last 3 years, there was only that much of limitation to increase rates. To answer your question, there is an upside of almost close to 20-25% from a rate perspective when you see the market being saturated with volume utilization.
Okay, so our average yield would be 25% lower to compared to the pre-pandemic levels, right?
Correct.
Okay. And the second part, sir, what would be the utilization level for Q4?
Q4 utilization level has been at 72%, which is the highest. Even before pre-COVID, we didn't have that kind of average utilization level.
Okay, sir. Thank you.
Thank you. Our next question comes from Rishikesh Oza with Robo Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. So my first question is regarding the interest cost. So what would be the interest cost going ahead with respect to the, NC, RPS that we have issued?
It will be on the same range for the quarter. So roughly around 7.8 crores for the full year.
Okay. And sir, also one data point on listenership. So could you share the listenership data for the radio industry? What is it currently versus pre-COVID level?
So the listenership data in the last survey that we had done, all the radio operators together, there was an increase of 25% listenership over the pre-COVID listenership. But currently what is happening is the new data service is happening, and currently in the next maybe a quarter you will see newer data points being released in terms of audio listenership, which will not just cover radio but the other audio listenership also, which will work from an industry point of view. But to answer your question, there has been an increase since COVID.
Okay. And sir, as per your press release, you mentioned, in your March, you have seen a 90% of utilization. So when do we see, when do we expect the rates to go up, like anytime soon, like in further 2-3 quarters or anything like that? Could you, pinpoint?
See, at the marginal levels, I think all radio players, including us, very clearly believe that, with the saturation almost coming near to 90% in the end of March, there will be a rate hike that will happen, and I think that's a measure which most of us as radio players realize will have to take, because otherwise you'll be in the business of over inventory utilization. So I think it's in the coming, but it all depends on how month to month and quarter the utilization level happens. The only catch to it is that while the leaders like us and a couple of others will have that kind of utilization level, there are few players still who have the utilization level still not at the maximum level. So they will try and play the rate game and that to an extent sometimes may be an issue. But to answer your question, we at the radio industry level confident, and we especially for Radio City, that there will be a marginal increase to begin with, but over a period of time we want to recover back to the pre-COVID level rates that we are talking about.
Okay, and just one more question, sir. What kind of revenue growth are you expecting for FY24?
See, I think in the next, not just FY24, I think in the next 4 to 5 years, you will see a CAGR growth of 20% as far as Radio City is concerned.
Okay. Okay. Thank you very much.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star, then 1. Our next question comes from the line of Ansh Manik with Aquarius Securities Private Limited. Please go ahead.
Thanks for the follow-up. Sir, with respect to the digital investment, so what kind of the investment we should factor in for the FY24?
So I think, right now what we are talking about digital investments is right now only in the form of people, because otherwise the exposure that we are looking from a digital perspective is using resident talent to kind of create content, put it on the social media space and monetize that, which is what all is happening internally. So the marginal increase that you would look from a staff cost, which is what we are talking about, is there. We're not talking about any, because this is more people-centric than technology-led or any software-led inputs that we are talking about in terms of increasing digital spend, at least for the current year that we talk about. So you will have the same percentage of increase that you saw from last year to this year from a people cost concern is concerned.
Okay.
And little bit of marketing that was there for last year also.
Okay, sir. Got it. And with respect to second part, sir, our quarterly run rate of other expenses is around 25 crores. So, should we consider as this a normal base for upcoming quarters?
With whatever little inflationary increase that you would want to look at, that is the only thing that you need to factor in. Otherwise, from a percentage perspective, like in the previous caller's response also has said, it's an efficient way of managing top line to cost to bottom line, and that is what we will manage. And barring inflationary cost, I think you can be rest assured that it's going to be the same.
Okay, sir. Thank you. Thanks for the clarification.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star, then 1. Our next question comes from Riya Mehta with Equators Investment. Please go ahead.
Thank you for giving me the opportunity. My question is more from the macro point of view. You said that in the next 3 to 4 years, you see a CAGR of 20% coming in. So where do you see this growth coming from? Because I think in terms of minutes per hour, we've already almost at level of saturation. Do you see the yields going up by almost double digits?
So, when you look at the whole ecosystem from a radio perspective, there are 2-3 areas where the increase can come. And now I'm currently talking about radio, and then I will talk to you about where the 20% CAGR is coming from. From a radio perspective, so the whole market is divided between big market, small market, and the saturation that we are talking about is the large, markets or ad check markets as we call, which is currently in the March level when we talk about 90%. But when you go into the tier 2, tier 3 cities, there is still a lot more gap in terms of the volume utilization level vis-a-vis the top markets that we talk about. So growth will come in the smaller markets to volume utilization, which is still not at the peak. In the top markets where we are peaking at 90%, there will be a marginal increase of yield, which will increase in revenue. And to top it up, the non-FCT as we call, which is not the pure FCT, the generated revenues that we create through linkages with solutions business or the on-ground led activation business with the COVID challenges not being there, will add on to the overall numbers. A. B. The digital traction that we are talking about, you would have seen from a 5 to 8%, and this year will be almost close to the next year should be 10% of our volume value. So that is the traction that will give you the larger increase in terms of the incremental increase in revenues vis-a-vis last year.
Okay, I think I got it. And in terms of digital, Are we at break-even level for the digital as a whole?
In fact, we have maintained that digital will be an EBITDA booster for us. So throughout the last 2 years of operation, digital has been giving us more margins than the pure radio margins for reasons we all know. But now that the radio margins has led to the threshold level, it will start giving the similar kind of returns from a top line to bottom line ratio.
Sure. Okay, I think that's it from my side. Thank you, I'll join.
Thank you.
Thank you. Ladies and gentlemen, a reminder, if you wish to ask a question, please press star, then 1. Our next question comes from Jigar Shah with AK Securities. Please go ahead.
Yeah, thank you for giving me this opportunity. So my first question is that what is the outlook on ad spend and how do you plan to further monetize your inventory levels?
So inventory level has been on the upswing the last 1 year, quarter on quarter. Given the mood of the various categories that we are interacting with and the fact that government is going election year, we believe that inventory utilization should be on the upside for the current year for sure.
Okay, and so my next question is that what was the ad pricing during the year? I understand the industry is still 20% below the pre-COVID levels. What was it for Radio City? Also, are we seeing any increase in yields from major contributors like real estate and pharma?
So we are, from a last year to this year, there has been a marginal increase. We would be at around 85% of the pre-COVID level inventories from a quarter perspective. But overall percentage is still at 80% if I have to look a year-long average and see between the beginning of the pre-COVID year to the exit of the pre-COVID year. So we believe that there should be improvement in margins in yields through ER, at least in the top markets, because those markets are already getting into a saturation mode. And like I said, the entire industry believes that the cost to run the business and profit margins are hit. We need to take that call, and if all the industry players together believe that there is a reason for them to take a call, I don't think it's difficult for us to get that incremental cost through yield because of the with the position each one of us are, and I think it's the right way to go forward.
Got it. Thank you. That's all from my side.
Thank you. Next question comes from Gurjot Aluwalia, an investor. Please go ahead.
Am I audible?
Yeah, you are audible. Yes, please.
Okay, so just want to understand what is the impact of an election year typically, because if I look at the last 2 general elections and the company's performance in 2019 and 2014, like financial year end, I don't see any significant jump in the revenue, hardly 10-12% in the last 2 elections. So what would be the typical impact for the election year?
So I think the reference that you're given for the year may not be the right references because government was already at its peak when it comes to advertising in those years vis-a-vis the current form of advertising investments the government is in. So I think that's the first point of difference between the references you are talking about. So I think to answer your question, I am seeing a 20 to 25% upside on the government spends because of the election year, largely because the base is, if I may look at the peak of government, 1/3 of what it was. So possibly your analysis during that period when the government was already running at the peak would have not really affected much. But today when the government is not at its peak, for reasons we all know about, we believe that 20-25% is a number which we should all be confident about.
Okay, got it. And secondly, just want to understand the overall industry as a whole and the structure. I mean, it seems like there is a huge dent in profitability for the business, right? I mean, when like Radio City used to do 200 crores, this is around 2015, now EBITDA margin or operating margin was about 30%. So now it's just about 10-12%. So I want to understand like how has the industry changed in the last 7-8 years with the same revenue? The margins are like less than half.
Yeah. So there are 2-3 reasons to that. One is of course the cost to do business was much lesser during the years, and in the current dent you have seen in the last 2 to 3 years is largely because the threshold level of revenues was not reached by any of the radio players, and ours is largely being a fixed cost business where most of our licensing costs and all are fixed. unless and until you cover those costs, you will always be in the red, as a player. But once that threshold level is crossed is where the profit margins and the bottom line seems to look better, which is what exactly we have done, because we have covered the threshold level of cost, and going forward from here, we believe the margins will only improve. So, to answer your question, largely it's because of the high cost that we pay on because of the licensing cost, for which the industry is lobbying with the government to kind of rationalize licensing costs, music royalty, and also certain costs that we pay to the CTI and so on and so forth. And that is an industry effort to be done to rationalize, because we are paying through our nose for those costs. But referring to us, like I said, in spite of all those things, we have registered a profit, and we believe that this is a story we would want to continue with the measures that we have taken in terms of efficiency management, and of course the growth engines that we are creating in terms of on-ground led activities and the digital revenues that we talk about.
Okay. So what is the fixed cost currently at, and at what rate do they increase every year?
See, if you look at last year, our cost has been what we believe is the efficiently managed cost, so that the revenues bottom line has gone. I think we should expect a 13-14% increase on costs and a much higher increase in revenues for us to take care of the profitability.
Okay, but my question is, what is typically the fixed cost base? Is it like 170 crore, 180 crore? What is that rough number right now, and then we expect it to increase 13-14% every year?
Out of the, if you look at our last year numbers, where we had done about approximately 170, so almost 150-55 crores of that is a fixed cost that we talk about.
Okay, and that increases about 13-14% every year.
Yeah, approximately. But the revenue growth will be much faster than that, because that 13-14 will be offsetted by our revenue. Like I clearly said, we are looking at a 20% CAGR year on year for the next 4 to 5 years. So there will always be that margins that you will have to increase your bottom line. And the operating leverage will continue as efficiently as we have been managing.
Okay, no, that sounds great. I hope you can execute on that. Just one last question on the cash distribution. So I think the company generated good reserves, about 300 crores. I know there is about 90 crores set aside, which has to be redeemed via those NCRPS. But any plans for the remaining 200 odd crores cash?
Yeah. So currently, as you know, that the digital journey for us has begun, and there are various opportunities that will come on the way as we go forward in our digital play, which is from an influencer marketing platform to a content creators board that we talk about, to kind of value that we will create for influencers in the marketplace. So as we go forward, looking at opportunities, and also because there is a lot of digital from a performance marketing, opportunities. We will be looking at in the next 8 to 9 months is where we'll be closely looking at opportunities which will help us increase the speed of growth from a digital perspective, and any opportunity that comes to us, either in the form of a content creator company or a media marketing company which is in the digital space, adding value to brands to engage with the audiences on the digital platform, we'll be open to that, provided it adds value to our overall business play.
Got it. But there are no acquisitions lined up immediately?
Because like I said, right now we are exploring opportunity areas. The moment we find that there is an opportunity that we want to lap up, because the cash reserveness is there, we will take those calls much faster than other people, because we can take those calls. Fortunately, the board is in line with our thinking in terms of increasing our digital presence and creating value for our stakeholders, because that is the segment which is going continuously.
Got it. Can I ask one more question?
Yeah, please.
Okay. So just on this 20% CAGR growth for the next 3 to 4 years, is it immediately going to start reflecting from Q1 onward? Like Q1 revenue of last year was about 44 crores. And so can we expect like 50 plus crore, 50 to 50 odd crore in Q1 and then similarly Q2, Q3? Or is it going to be a lag effect in the festive season?
I would not be diplomatic out here, but if I have to look at the 20% growth as the business gets distributed between Q1, Q2, Q3, Q4, a percentage very close to that is what we will be looking at for sure, because that's where the growth is coming from, and I don't want to be defensive here because lag effect, if suppose for whatever reasons I'll say that the growth is 10 to 15%, that means I'm expected to go at 30% in the second half of the year. So when I'm saying 20%, I'm sticking my neck out and saying we will be close to 20% from a quarter on quarters, a little bit here and there, but I'm putting my neck out and saying that it's going to be that.
Okay, thank you so much. I think that is really helpful. I think this industry has been one of the worst hit ones of COVID, and we're waiting for your performance to turn around. So thank you so much and all the best.
Thank you so much. Thank you.
Thank you. Our next question comes from Karan Sharma with AU Capital. Please go ahead.
Yes, am I audible?
Yes, you are audible.
So can you elaborate on the interest on NCRPS component in the profit and loss?
Come again, sorry, I didn't get you.
Can you elaborate on the interest on NCRPS component in the P&L?
So we said that around roughly 7.3 crores annually, to the same range what we have been discussing from a quarter perspective. We had already said about 1.93 was what was done for the quarter. You'll have the same average. So around 7.2, 7.3 crores is what we will see at the annual level. Approximately about 2 crores per quarter is what you can take if you want to round it off.
That will be all from me.
Sorry?
Hello?
Yeah, tell me.
Hello?
Yeah, can you hear us? Hello?
Sir, Karan has disconnected his line from the question queue. We move on to our next question, which is from Riya Mehta with Equators Investment. Please go ahead.
Hello. Thank you for my follow-up question. My first question is in regards to the growth which we are guiding for. How much would come from volume, which is the inventory, and how much would come from yield?
So if you really want to give me, for me to give that answer will be on the basis of how the industry gets played for the quarter. But I would want to say that almost 80% first quarter will come from volume, and then a marginal 10-15% will come from the yield increase, because there are markets yet to be saturated as far as the first quarter is concerned.
Okay, and going forward, this volume would go down and yields would increase, is what I heard.
Here, like I said, given the large market, small market distribution, if you have been listening to me, I think you can, for the thumb rule, put almost 80 to 85% for the current years will still be volume, and about 10 to 15% will be the value.
And in terms of government advertisement, what are the yields like? Is it lower than the normal real estate and education? And how does it pan out? Could you give some more insights on it?
Look at the correction that has happened over the COVID period. The government rates are pretty much in sync with some of the core categories, but there is a room for improvement, and we believe that increase the government is already taken note of, and if all goes well, we should be in a happy position to give you the details that the government has already decided to increase rates for the industry.
Okay, so does the government come up with 6 monthly or annually revised rate, or how is it?
So the government decides it once in a while, so it's not, the impact for us, for the radio industry, the growth has not been taken for the last at least 5 to 6 years. So that's the reason why we are confident after individual representations by individual players as AROI and the government have realized that at least from a government perspective, the radio industry is underplayed from a value perspective, and that is the reason why the government, through TRI recommendations, is planning to increase, and we have got indicators that it's almost there on the card, and hopefully before the next quarter, if that comes in, I should be in a happy position to say that the rates have increased.
And there was a case law where between all the radio companies and a particular company, wherein we have also basically, I think you've appealed to the court that the case law was regarding radio players having to pay a certain amount to the author or the original composer. So could you give some more insights on what is it right now?
See, it's still sub judice for us because whatever claims that is being given and the references that have been given are being fought because the industries have right now it is sub judice in the Supreme Court.
I think Madras High Court had given a ruling in favor of the other party.
And that we have appealed against it, and it is right now in the Supreme Court.
Okay. If it comes against our favor, what would be the material impact on our revenue?
Honestly speaking, the way the whole, we are confident that it will not be negatively impacting us because we are, given the situation and the circumstances, there's no way we would be asked to, pay the, that responsibility we believe lies with the labels.
Okay, thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star, then 1. Our next question comes from Ansh Manik with Aquarius Securities Private Limited. Please go ahead.
Thanks for the follow-up opportunity. Sir, with respect to March utilization of 90%, volume utilization of 90%, if you can guide us what led to such high utilization, that would be helpful.
March utilization of 90%, what was the last statement? I didn't hear you.
So if you can guide us what led to such high utilization or...
So yes, the industry has started, real estate has started advertising in a big way, given the fact that markets have opened up. Certain segments like auto has started investing. So the categories which is buoyant and has an affinity towards radio have started advertising, and hence the increase of utilization levels has happened.
So similar trend would be also observed in the month of April.
Pardon me?
So what would be so similar trend would also be replicated in the month of April, or there was any decline in utilization?
See, typically what happens is, if you look at the way investments happens on radio or largely on various mediums, the third quarter is the highest quarter, followed by the second quarter. Then the first quarter is the lowest quarter, and then the second. So you will find that the utilization level will fluctuate between investment that happens on radio. And I'm repeating myself just in case you have missed the point. Third quarter is the highest, so you'll have the highest level of utilization. Not surprising because that's the peak season and the festive season. That is followed with the fourth quarter, which is the highest investing quarter across mediums. I'm not just referring to radio. Then followed by the second quarter of the year, which is financial year. The first quarter happens to be the weakest in terms of utilization level and also from revenue generation perspective.
Okay.
Sorry.
Ansh, do you have any more questions for the management?
No, thank you.
Thank you. Our next question comes from Aditi Kapsekar with an investor. Please go ahead.
Hi, are you able to hear me?
Very much clear, Aditi. Good afternoon.
Good afternoon, sir. Thank you for the opportunity to ask the question. So I saw that, in terms of your volume contribution, at least in the fourth quarter, real estate and finance and pharma are the top 3 sort of industries that contribute to your volume. But, going into the election year, we are expecting government to start contributing higher, which is currently at about 7%. So do you expect this mix to change dramatically? And if yes, then is it that, in terms of sort of the margin or the rate increases that are allowed, are the rates different across sort of different clients depending on which industries they come from, etc., or is it fairly uniform? Like even if, for example, government were to become, say, 20%, does that mean that it's a relatively lower margin business compared to what a real estate would be giving you, or are the margins fairly sort of, just dependent on that 155 crore of fixed costs and then the operating leverage that comes from there on kind of a metric?
See, real estate and food and soft drinks inherently will be slightly lower on rates because that's the way the industry and the category operates.
Mm-hmm.
So if you are looking at rationalizing real estate costs versus government costs, the government rates will be slightly marginally better than the two categories that we are talking about.
Mm-hmm.
However, categories like finance, auto, and electrical and electronic appliances will be higher on rates as compared to government as of today.
Okay. Got it.
So I think currently, if I have to look at it from last year's contribution, if government increases, given the fact that your top two categories out of the 5 is food and soft drinks and real estate, which is slightly on the lower end of rates as compared to relatively, you'll find a higher yield coming if that happens. Sorry, if government comes in.
Got it. And sir, that's clear. And sir, the second question was, you mentioned that 155 crore odd is the sort of fixed cost, which will probably grow at 13-14%. And then if we assume that the remaining 10% is the variable cost, which sort of remains variable, then, we would be possibly talking about EBITDA margins, which are sort of 25% plus kind of levels, which is something that we've seen in the last cycle. But do you believe that, getting to those kind of levels is sort of feasible in the current environment over the next 1 year or so?
Very much feasible.
Yes.
If all goes well, we'll demonstrate that in this year.
Understood. That's clear, sir. Thank you very much.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Ashit Kukian for closing comments.
We sincerely appreciate your participation in today's earnings call. I am confident that Radio City will continue to deliver on stakeholders' expectations and live up to the trust reposed in it. The presentations, earnings release, and results are all available on the corporate website and stock exchanges. If you have any other further queries, please get in touch with any one of us or with strategic growth advisors or investment relations partners. Stay safe and take care. Goodbye.
Thank you. On behalf of Music Broadcast Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.